When a 9-week equity rally collides with a hawkish Federal Reserve repricing and an AI investment boom, the risk-reward in stocks can change quickly. Welcome to vTalkInsight, Equity Pulse Daily for June 2nd, 2026. Let us unpack how growth, inflation, and AI-driven earnings are reshaping today's equity landscape, and what that means for leadership, valuations, and volatility. Macro data continue to surprise on the upside just as the policy debate turns more hawkish, and that clash now anchors the equity narrative. U.S. growth is projected to approach 4%, strong for a mature economy, with ISM manufacturing beating expectations at 54 and forecasts for another solid month of hiring and unemployment near 4.3%. Job gains in construction, manufacturing, healthcare, and education are supporting capital expenditure plans and, in turn, corporate earnings. That backdrop gives equities a solid nominal growth base, even before considering the additional boost from AI-related productivity gains. Inflation, however, has not convincingly broken lower. AI-related investment, large data center buildouts, and government spending are adding demand into already tight energy and labor markets, and markets have swung in 2 months from expecting multiple Federal Reserve cuts to debating a rate hike this year, with the 10-year Treasury yield back above 4.5% and the yield curve flattening toward its lows of the past year. Equities, therefore, have to balance robust nominal growth against higher for longer real yields and reduced policy flexibility. Some see the front end of the curve as still too optimistic given persistent inflation and upside risks from energy, while others point to lower rate volatility and reduced corporate rate sensitivity as many issuers have termed out debt at low coupons. Overlay a roughly 6% of GDP fiscal deficit that is temporarily boosting corporate profits, and it becomes clear how reliant the current equity regime is on benign inflation and steady capital flows, making upcoming CPI and labor releases critical for the valuation backdrop. AI-driven earnings remain the core support for equities, and that profit engine is still powerful enough to offset higher yields. First quarter S&P 500 earnings came in roughly $10 ahead of expectations, and putting a 20 times multiple on that surprise implies meaningful upside if it proves durable, with the standout beats in U.S. technology where many large-cap names delivered upside and confident guidance, even as Treasury yields pushed higher. Semiconductors and hardware sit at the center of this story. Chip sector earnings grew about 25% year-on-year in the first quarter, underpinned by hyperscaler spending on AI infrastructure that is expected to remain robust for several years. NVIDIA remains the bellwether. Its data center dominance is now being complemented by a move into AI-focused PC chips for Windows laptops, supporting both NVIDIA and ARM holdings and helping drive the S&P 500 even when other growth or energy-sensitive sectors lag. At the same time, valuation dispersion is widening, with NVIDIA's roughly 80% revenue growth and mid-20s earnings multiple contrasted against peers on richer multiples but weaker fundamentals, which puts more emphasis on stock selection across the chip complex. The AI capital expenditure wave is also spreading beyond pure technology. Alphabet is raising tens of billions of dollars, including a $10 billion private placement with Berkshire Hathaway, to fund an end-to-end data center and chip build-out that could push its annual capital spending toward $80 billion, while SoftBank's plan to invest heavily in French data centers, alongside major U.S. projects, shows how AI is becoming an industrial and infrastructure theme. Some strategists argue this AI-related capex could more than offset the drag from higher oil prices at the global level, helping explain why equity indices continue to grind higher despite rising yields and energy costs. The open question is whether earnings breadth can extend beyond a narrow AI cohort so that today's concentration risk matures into a broader, more durable growth engine for the wider equity market. Energy and geopolitics remain key wild cards for both inflation and sector leadership. The Strait of Hormuz has been effectively constrained for close to 100 days, removing around 1 billion barrels from global supply and forcing shipping to reroute, with attacks on vessels more frequent than public data suggest, and the prospect that even a reopening could take months to normalize flows. Price action reflects that tension. West Texas Intermediate crude recently jumped into the low 90s on renewed Middle East risks, and even after an 11% pullback on speculation over U.S. and Iran talks, oil is still about a quarter above pre-conflict levels, while global inventories trend lower and some Asian markets already face rationing and demand adjustments. This feeds directly into the inflation debate. Higher energy prices, rising input costs, and signs of price hikes from China all add to upside risks at a time when markets already see U.S. inflation as a choice between a return to 2% or a move above 3%, and with the 10-year yield back above 4.5% and upside risks toward 5%. Further oil shocks could quickly revive fears of equity multiple compression. At the same time, the energy sector is regaining strategic importance. European policymakers are pivoting from a pure ESG focus toward energy security, and the AI data center build-out is hugely power-intensive, with flagship projects expected to consume more than a gigawatt of electricity. Tying the AI theme directly into long-term demand for generation and grid investment and making energy-sensitive sectors a crucial barometer for how long the current equity expansion can run. Positioning and market structure are adding another layer of risk on top of the macro and earnings story. The S&P 500 has logged an extended run of gains and is close to a 10th straight winning week, a pattern last seen in the mid-1980s, yet breadth is narrow, with only about half of constituents trading above their 50-day moving average, and information technology and energy doing much of the heavy lifting. Derivatives and retail flows are amplifying that narrow leadership. Options activity shows historic levels of call buying across a broad set of stocks, with call demand outpacing puts in more than 70 S&P names, and realized volatility concentrated in the names that have already rallied the most, creating something closer to an up crash than a slow melt-up. Because much of this is upside call demand rather than downside hedging, the VIX in the mid-teens may be understating how much risk has built beneath the surface. At the same time, systematic and discretionary equity positioning remain relatively subdued, and many portfolios are still underweight the AI leaders, a mix that can fuel further upside as investors chase performance, but also raises the risk of a sharp reversal if sentiment turns, and those same investors de-risk into weakness. With elevated valuations and a 10-year yield above 4.5% with upside risks toward 5%, some observers see echoes of past periods when higher rates or a funding shock eventually capped late-stage rallies, especially as financing conditions remain easy in parts of private credit. That context makes the market more sensitive to any negative policy or growth surprise. The upcoming IPO wave is another swing factor. SpaceX, Anthropic, and other AI and technology names are preparing to list at ambitious valuations, often with structures that concentrate power. SpaceX's roughly 85% voting control for Elon Musk stands out, and faster index inclusion could force passive inflows just as retail allocations are peaking, which is why several voices flag the June to October window, when large IPOs, Federal Reserve uncertainty, and U.S. political noise coincide, as one where the risk of a meaningful equity drawdown is higher. At the individual stock level, dispersion remains high, reinforcing that this is not just an index story. In housing, Berkshire Hathaway's $6.8 billion all-cash acquisition of Taylor Morrison at roughly a 24% premium is a notable signal. Berkshire plans to integrate Taylor Morrison with its existing home-building assets, a shift from its traditional hands-off style, and is making this move despite high mortgage rates, weak sales volumes, and demographic headwinds, while still retaining capacity for larger deals. Mergers and acquisitions are picking up elsewhere too. MGM Resorts rallied more than 15% on reports of an $18 to $19 billion buyout bid by Barry Diller, highlighting appetite for hard asset-rich businesses as potential hedges against macro uncertainty, while in Europe, EasyJet has seen double-digit moves first on speculation of a Castlelake bid and then on management's firm denial, underlining how quickly perceived value in asset-heavy cyclicals can be repriced and how regulatory constraints complicate cross-border control. Technology and healthcare moves tell a similar story. Hewlett-Packard Enterprise jumped almost 30% after reporting about 40% revenue growth and raising free cash flow guidance, with networking now contributing more than half of profit, while Dell and NetApp also pointed to stronger demand for servers, storage, and networking tied to enterprise AI investment. By contrast, Wise slumped on news of a money laundering investigation, and Rocket Lab fell after a Blue Origin rocket failure weighed on space-linked names, even as Revolution Medicines rallied on pancreatic cancer data that significantly improved survival, reminding markets that stock picking still matters beneath the AI megacap narrative. Stepping back, the equity picture is defined by a powerful clash between accelerating U.S. growth, sticky inflation, and an AI-driven earnings boom that continues to pull indices higher. Policy expectations have swung from cuts to the real possibility of renewed Federal Reserve tightening just as oil, geopolitics, and energy-hungry data centers keep inflation risks alive, while AI-linked capex, exceptional tech and semiconductor earnings, and renewed investment in infrastructure and energy underpin a strong medium-term growth story. The tension is that leadership remains narrow. Options activity and retail flows are pushing some names into parabolic territory, and an unusually heavy IPO calendar sits directly in the path of a market already priced for good news. From here, the key signals are upcoming inflation and labor data, the behavior of long-dated yields, oil and energy-sensitive sectors, and the early trading of high-profile AI IPOs. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.